Gentlemen, welcome back to MGTOW Money. Today's topic, what this billionaire just told me. Before we get to that, as always, let me sincerely thank the ongoing support from the Patreon investors in this channel. Quintuple A, Darren, the newest ones. Thank you guys. Thank you so much for joining. Gentlemen, see the video description of today's video. Consider becoming a Patreon investor in this channel because this endeavor is going to continue until our good friends at YouTube decide to take it down as they're doing to many other channels. All right, let's get on to today's topic, what this billionaire just told me. Specifically, I'm talking about Warren Buffett, and I'm sure many of you have heard my name or heard his name. I've mentioned it before. You probably have heard his name before. He is also known as the Oracle of Omaha. As some of you may know, he recently released his company's latest investment letter sent to all their shareholders. And before I get into three key ideas that I'm taking from his most recent investment letter, I think it's important for all of us that we have at least just some sort of brief background about who we're talking about, because he is, quite frankly, probably the greatest investor in the entire history of the world. That's not an exaggeration. And furthermore, not surprisingly, he is also one of the richest men in the world, a net worth of north of $50 billion. And gentlemen, this is where it gets very important. He didn't make his money in real estate. He didn't make his money building a business. It's not Mark Zuckerberg who starts up Facebook. It's not Jeff Bezos who starts Amazon.com, etc. Basically, how he's made his money, how he started in about 1965 with less than $10,000. It was actually evidently about $9,800. He started with that small seed money of just investing properly. And specifically what he did, men, is he started acquiring assets, specifically buying shares of companies, portions of companies, in other words, small percentage of companies, and obviously he increased this and started buying companies outright, and that's how he took this initial capital of less than $10,000 to the present day of over $50 billion, simply by investing his money and compounding, this is the key word, compounding that money. In other words, what I'm talking about when I say compounding, I'm just going to give you a simple example, as I'm sure a lot of you have heard of as children. Let's say you take a job and you say, hey, look, I just want you to pay me 1 penny and then double it each consecutive day. Well, try that. Do the math on that. So, for example, 1 penny is 2, is 4, is 8, is 16, etc. You can see within you get about 25, 30 days out, you've got this exorbitant amount of money. That's what we're talking about with compounding. Or another example, for example, if you're putting your money in investment and you're getting a 10% per year return on your money, again, 10% per year, you will, in approximately 7 years, double that money. So again, you can see the effect of compounding. In real life, his company, Berkshire Hathaway, which is simply a collection of a whole bunch of businesses and shares in other companies that he's acquired, has increased in value 1,300,000%. In other words, 1.3 million%, his value of his organization has increased from 1964 to May of last year. So it's that much higher this year, of course. This is the most recent record I can get. So in other words, again, it's increased 1.3 million%. It's compounded that amount. Versus, by the way, the S&P 500, in other words, just sort of the general stock market, has gone up 2,700% during that same time frame. So in other words, he has outdone the overall stock market by 500 approximately %. That's an amazing rate of return. And that is, unfortunately, though, very easy to say in terms of, well, it's easy to just invest correctly and buy value stocks, etc. However, as we all know, or at least most of us know, this is not easy to implement. And especially when you're talking about a long-term investment. Look, many of us can do 20%, 25% a year, couple of years in a row, etc. Doing it over a 30, 40, 50-year period of time, in particular when you've got billions of dollars to invest, which he does, it's almost statistically, mathematically almost impossible. All right, though, let's get to some ideas that you and I can use, that we can use on our day-to-day basis. These specifically came out of his most recent investment letter. I highly encourage you to look at it. It's available available for free on the internet, or even better, I'm going to include a link to a book in the description that actually has all of his letters, all of his shareholder letters that he sent out going back to the 1960s. These are very easy to read. The book is $2.99. I highly recommend it. If you don't want to spend the $2.99, then go to the library, or you can go to their website and get the letters. It's just nice because the book has all the letters all collected together. All right, one idea you need to take right now, in my opinion, is that he is sitting on, in the bank, if you will, literally in the bank, $113 billion in cash. You heard what I said, $113 billion with a B in cash. And by the way, this has increased 25% from last year. Now, why I think this is so interesting, why is this guy sitting on $113 billion just sitting in a bank account that's hardly earning any money? And as he says, I'm paraphrasing, he doesn't see any compelling values. He doesn't see anything really. He feels like this is a great deal. This is a great price that I can buy this at. This guy, by the way, is the ultimate, what I would call a vulture investor. In other words, when Warren Buffett steps into an investment, he's looking to buy after the market has crashed. During 2008, 2009, he became, so to speak, the lender of last resort. When all these companies were literally on the verge of bankruptcy, when nobody was going to loan him a dime, guess what he did? He said, sure, fella, I'll loan you some money. Sure, Bank of America, you're literally about to go into bankruptcy. I'll loan you some money. It's going to cost you 12% interest. And, oh, by the way, you got to give me a chunk of your company. But they felt like, well, that's better than us going for bankruptcy. And I'm just using round numbers here, but that's exactly what he did. He became sort of the pawn shop to all these huge corporations. In other words, he stepped in when nobody else was willing to. Number two, he has a tremendous amount of patience. And that sort of ties into what I was just saying. He waits. I mean, he sits, he does nothing. As he talks about in other investment letters, he talks about how sloth is kind of his way of investing. He waits for that fat pitch is another way. He has no bias for action. He has no concern of fear of missing out. He has no concern of, well, hey, that stock just dropped 50% in value. He has no concerns. He can sit for a long period of time, unlike most of us, unfortunately. So the important fact that I think is important here, you've got to have patience. Now, I think it's also important, though, no matter what you're investing in, you've got to make sure that you're buying at the right price. At the right price, meaning you've got to be careful that you're not buying something at the height of the market. In other words, that you're getting real value, that you're buying a real asset. Let me give you an example. There's lots of people who are buying high-tech stocks back, let's say, 1999, 2000, for example. Intel, Cisco, etc. Yeah, these companies are still around, but if you bought and held, if you bought then and held to today, frankly, you've lost money. You're still underwater. The value of the company is worth less than it was back when you bought it. So you've got to not only be patient, you've got to buy real assets at the right price. Again, much easier to say, much more difficult to do. Something, though, that we can all do that I take from his investment letter is humility, both in your personal life and in your investing life. You've got to be able to clearly admit your mistakes. He says, for example, again, this guy's a billionaire. He says, look, I screwed up. We lost money here. I didn't invest in Amazon.com. For example, he said last fall he thought that Amazon.com was overpriced, etc. I think it was in the $90 range. Now it's like about $150. So again, he admits very clearly, he doesn't have to do this. I messed up. I screwed up. It's okay because he knows there's another buying opportunity inevitably coming down the road. Furthermore, he talks about, regarding his own personal spending, how his company is so focused on taking on no debt, and I presume this translates into his personal life. In addition, as you may or may not know, where's his company headquarters? Is it in San Francisco? Is it in New York? Is it some high-flying place? No, actually, it's sitting in Omaha, Nebraska. And oh, by the way, the house that he lives in Omaha, Nebraska, is the same one that he's lived in since like 1955. This guy is very modest. He's very simple. He is the quintessential, if you will, the typical billionaire billionaire next door. And he emphasizes the importance of no leverage, no debts, buy assets, no liabilities. Does this sound like any other YouTube MGTOW who talks about a lot of this stuff? All right, let me give a quick summary here. Warren Buffett is a true legend of investing. When he talks, people listen, and I emphasize we all should listen. He invested his money in the stock market, and that's how he became a billionaire. Not by starting a business, not by speculating in cryptos. He did something extraordinary that very few of us are going to be able to do, but by following his ideas, some of the principles that he talks about, we can, if nothing else, increase our probability of success and get us closer to his net worth. Again, one, he's sitting on cash right now. He recognizes cash is not trash. If in doubt, stay out. Look, I know that some of you have a 401k, for example, through your employer. And I've seen some of you say, well, I don't know what to do with my cash. I can virtually guarantee you, no matter your savings plan, you have some ability to just sit on cash. If you feel like the markets are overvalued today, it's okay. I can promise you there will be another bull market and something down the road. If you miss this one or you miss the next one, again, there's going to be a third and a fourth. There is no such thing as a fear of missing out except for in your head. Two, you've got to have some patience. That sort of ties in what I was just saying. You've got to be willing to look at buying assets at the right price, and that ties into the right time. I don't know if today's the right time to be buying some of these assets in the public markets. I'll leave it at that. I'm not a fortune teller. Next, you've got to be humble. You've got to be willing to admit your mistakes. And furthermore, to tie into that, you've got to recognize your downside. In other words, any money you put into the market, you've got to be willing to look at it and just say, hey, look, that could drop by half. Can you sleep with that? Are you good with that? Because it feels a lot different to say that than to actually watch your money melt away. That $10,000 you put in and you open up the brokerage statement and now it's only $5,000. So the point is, you've got to be willing to recognize that maybe you made a mistake. Maybe this investment was not such a good idea. Maybe you should take your $5,000 off the table and think about something else. So that's just an idea. Or, as he recommends, if nothing else, putting the majority of your money. I recommended, for example, you could put 80% of your money into a standard index fund. Again, I'm emphasizing, maybe not today. I don't know when. Maybe I'm wrong. Maybe the stock market's going to double. I don't know. But you need to be humble enough about what you're doing with your investments that you can be wrong. You need to recognize that right up front. And that correspondingly ties to about investing in non-correlated assets. The last point I would mention is, and I've said this numerous times before, is avoiding debt. I understand many people get extremely wealthy using, for example, leveraged real estate, some of whom also buy margin stocks. This can be a fantastic way to make a lot of money. It can correspondingly be a way to lose a lot of money. I would just say, be very, very careful because it does require, when you're handling debt, a high level, and I emphasize that, a high level of a financial intelligence. All right, gentlemen, if you haven't already, hit the subscribe button. If you found this useful, hit the like button. As always, John Galt out.